Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning with our money for our financial investment and retirement future. He is president and founder of Mcintire Retirement Services. Chris Mcintire here with us. And Chris, quickly closing in on the end of the year. So today's program about the reminders of some of the opportunities that we have to better control our finances and make forward progress toward our goals.
Yeah, absolutely. You know, everybody puts their Christmas list together, what they want to get under the tree. And, you know, we can talk about some of the wish list items that people can take a look at here as we work our way into 2023 and beyond. And, you know, it's been a challenging year for sure, Peter. We've had, you know, stock market investments down, bond market investments down significantly for this year through, you know, rising interest rates, the threat of inflation, a number of different things. And, you know, we always try to convey a message of, look, there's always an opportunity out there. You know, for those of you that are still working, the opportunity is continuing to make those contributions, and you're buying more shares of stocks and whatnot, you know, in your 401k plans while the market is down. That's dollar cost averaging. That's certainly a good thing to do for those that are currently working. But, you know, I think we're going to transition, talk about some folks that are already retired as well on today's show.
Absolutely. Always both sides of that retirement planning picture. There's pre-retirement, there's during and post-retirement, and then there's the transitionary period where things kind of get really complicated. And you only want to do that once, ladies and gentlemen. You want to do it the right way. And Chris Mcintire is your guide all the way through that process. If you've got questions, if you would like that complimentary review and retirement planning strategy session with the written game plan for your retirement, pick up the phone and give Mcintire Retirement Services and Chris Mcintire a call for that complimentary opportunity for a one-on-one detailed review and strategy session. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, in particular, the end of the year really is a time where we need to think more proactively about tax planning. And a lot of times we sort of put that one off and think about that only in the first part of next year when we're preparing the returns, but maybe a whole lot more effective to go ahead and be proactive and take a few simple steps now.
Certainly. And, you know, we'll start with IRA type accounts right now. So, you know, if you're a regular investor with a stock bond mixture, obviously, you know, we've got, volatility, and probably your portfolio is worth 10 to 15% less now than what it was at the beginning of the year. And so one thing you can do is take some or all of an IRA account and convert it to a Roth IRA. So if it's fallen in value 10 to 15%, you know, that taxable consequence is 15% less than what it was going to be, you know, based off the value of the account. You move it into a tax-free Roth IRA. Yep, you have to pay tax on the converted amount, and anyone can convert. So this applies to anybody out there working, not working, under 59 and a half, over 59 and a half, over 72. You can put money from a traditional IRA, slide it over into a Roth IRA. So if you've got your stock portfolio took an absolute beating this year, you can simply move that into a Roth IRA, or convert it into a Roth IRA to be technically correct. Pay the income tax on the converted amount, and then let it recover income tax free, no required minimum distributions, doesn't factor in to make your Social Security taxable, doesn't affect your Medicare premiums, you know, further down the road. Obviously, if you convert it, there's some tax implications that could have an impact on Social Security and Medicare costs as well. But you're setting yourself up for tax-free money down the road that might avoid a lot of the loopholes that you're currently walking through right now.
Some significant advantages, but I think some cautions there as well. You just have to know the pros and cons of that potential move. Yes, you're going to have to pay taxes. Yes, if you do convert, you've got to understand those implications on potentially Social Security and Medicare premiums. But Chris Mcintire can walk you through those, ladies and gentlemen, and he's got some great software to run illustrations and detail what that might look like for you. Not only the cost for doing those conversions, but the savings over a projected lifetime. And he can help you better understand what that looks like. Often a significant savings, and it's not what we have for retirement, it's what we get to keep out of it. So do yourself a favor. You owe it to yourself to look at those numbers carefully, because it could be a substantial amount of money that you save and protect, and then that you grow tax-free for yourself, for income, for inheritance into the future. Give Chris a call if you'd like to run those numbers, see what a Roth conversion strategy might look like for your situation. 800-868-1194. That's 800-868-1194. Chris, you mentioned a couple qualities, whether you're younger than 59 and a half, older, pre-retired, already retired. Another big one is a lot of people that are making reasonable household income are eliminated from putting new money into Roth IRAs, but that conversion does not have those income limitations.
That is correct. And that's why we say anybody can convert, not everybody can contribute. And so those are the two C words that deal with IRAs: contributions and conversions. And contributions means you're working, you have wages that come in, and there are income limitations, like Peter says, for people who can deduct their contributions into an IRA or even contribute into a Roth IRA. I cannot contribute to a Roth IRA whatsoever. I have to walk through some loopholes to make that happen. And, you know, it's kind of funny that they put in these stipulations to say, well, you can't do this, but here's the loopholes to get around it. So obviously there are always, you know, some ways around some of these, some of the contributions. But from the conversion side, which is more important here at the end of the year tax planning side of things, is anyone can convert. And that doesn't mean everybody should convert, though, Peter. And, you know, sometimes it just doesn't make sense. There's not enough money in an IRA account that it makes sense to convert it to a Roth. You're going to leave it to a charity anyway. That would be another example. They're not going to have to pay tax on it. You're going to give it to them tax-free, basically. If you have a significant amount of money in IRA accounts, that's where it comes into play. So, you know, we always look at it, you know, and just for general purposes on the radio show here today or the podcast, you know, we're going to say, you know, probably 500,000 and above is where there's more significant long-term benefits to Roth conversions versus under that dollar amount, generally speaking.
Yeah, well, I will add a third C to that: complicated. with all those conversions and contributions. It can get tricky, but Chris Mcintire knows the ins and the outs and the strategies, and can again run the scenarios and illustrations to show you and quantify what the potential cost and benefits are if you are to consider this strategy. But again, you want to see that for your individual specific situation. Chris sent over a few examples before the program, ladies and gentlemen, of a theoretical 62-year-old couple with a $2 million nest egg, and the tax savings over the course of their projected lifetime, almost half of the current balance. In fact, a little bit more than half of the current balance was going to be the tax bill on a projected life expectancy to 90 years old, but that was able to be decreased significantly. And again, you want to keep as much of your hard-earned money as possible, and you want to see these scenarios for your situation. So pick up the phone and give a call, 800-868-1194. That's 800-868-1194. Chris, taxes being one of our largest known expenses in retirement, we want to do everything that we can to control that. And there is, in fact, some risk involved with taxes. We fondly refer to it as legislative risk to give it a nice, warm, kind of fuzzy feeling, or at least a name. But basically, it's tax risk. What is going to happen with taxes into the future? And we don't necessarily know what's going to happen with the market or inflation into the future, but we do have a pretty good glimpse what the future of taxation may hold, at least in the short term. Why is this an opportunity that may be better to be considered now than later?
Well, now we know what the tax rates are. We know where they stand historically, and it's very low. We know in 2026, tax rates are going to reverse back to where they were before. Let's call them the Trump tax cuts, not to get into politics here, way too close to an election. But when President Trump was in office, they lowered income taxes. So the 15% bracket went down to 12%. That's a significant change for middle America. So that's where we do a lot of the Roth conversions, is in that 12% bracket. So in 2026, that if they don't extend them further, which none of us know, though that 12% bracket is going to go back to 15%. So if you maxed out your income in the 12% tax bracket, that eventually becomes the 15% bracket. That's somewhere around $1,500 to $1,600, $1,700 more in taxes right there that you're probably going to have to pay. If your children are in a much higher income tax bracket than what you are, and if they're going to be the beneficiaries of it, of the IRA, that's another reason we would want to consider whether or not we do Roth conversions. And normally, Peter, when we're doing this, it's always, we want to caution people, look, make sure you're doing your tax homework. Consult with your CPA, your tax planner, to have them run some scenarios. Look, if I'm going to convert $20,000 this year or $100,000 this year, what are those implications? So make sure you're doing your homework there. And obviously our clients, we typically, are managing some of their tax situations. We work directly with the CPAs also, which, makes it a lot less work for them, of course. And that's a good thing.
Well, every financial move has tax implications because there is never a dollar earned, grown, created, spent, taken as income that does not have some type of tax plan associated with it. And Chris, you provided another couple scenarios here, and don't try to get too much into the weeds of complicated numbers over the radio airwaves, but you gave that theoretical situation of a married couple earning $150,000 now versus what tax rates are slated to increase to in 2026. Whether that's $150,000 of income or including these Roth conversions, in 2026, $150,000 of income will essentially cost us about $4,758 more in taxes. So a substantial opportunity to have some real savings by doing this now while we know tax rates are lower. And basically, if you ask folks, I think, Chris, 10 out of 10 would agree without even knowing that taxes are already slated to go up in 2026, that taxes are probably on the rise for the future. So again, a good time to make this consideration and look at these numbers for yourself, ladies and gentlemen, for your situation, for your tax deferred account balances. Do some proactive planning before the end of the year. We've got 4 years of lower taxes right now slated and in law. So we've got to take advantage of that, including 2022. And these things need to be done before the end of the year to take advantage of 2022. So give Chris a call, 800-868-1194. That's 800-868-1194. Now, Chris, we have heard all about inflation all year long. There are a couple silver linings to this. One is that next year, Social Security recipients are going to get a historic increase not seen on this level since 1981. And two, 401k, IRA, and retirement account contributions are all going to be increased next year. So we're talking a lot about managing taxes here. Do you think that these increases to contribution limits are a good thing? And something that most people should or are going to take advantage of?
Yeah, I would say generally speaking, it is certainly anytime the government allows us to put more money away for retirement savings is a good thing. The other side to that is those are tax deferred contributions, that eventually will become taxable contributions. So again, we might be, over the long haul, we're adding more money to an unknown taxable account and pay income tax rates at an unknown rate. And I guess, on the surface, look, if they're giving us the opportunity to put more money for 401ks, that's going to be a good thing. The Social Security increase is going to be a good thing. Medicare premiums actually are coming down about $5 for most individuals here. Again, depending on what your income tax bracket is, depends on what you pay. It depends on what your Medicare premium costs are. So I think it's like $173 going down to like $168. There was an Alzheimer's drug that they negotiated a price difference on. So normally when that Social Security cost of living adjustment goes up, Medicare premiums also go up, and that, sometimes negates that. So this is a pretty good
in tandem, it seems like.
Yeah, there you go.
But this is an exception.
Yeah. Yep. This year's an exception. So, and especially with so many Social Security recipients fighting this cost of living adjustment and whatnot, it'll be a good thing. I don't know how good it's going to be for Social Security's long-term funding, but that's an issue for another show. The standard deduction is going up. So a lot of significant tax elements are going to be important in 2023, and we'll certainly keep you up to speed on all of those things as it rolls out. We're coming up into the end of the year of 2022, so we'll keep our focus on that. And, the other side, Peter, is, we've been focusing on IRAs, Roth IRA conversions. Another tax strategy is, if you've got money outside of an IRA account, a regular brokerage account, and it's down in value, you may want to sell some of your losses to offset future capital gains. You know what I mean?
Yeah, there is a strategy, Chris. And again, specifically in non-retirement accounts you're talking about here, but where you essentially wash the gains and the losses so that you can capture those and offset them and not pay taxes on some of the gains, tax loss harvesting. And this is another move to consider before the end of the year.
Yeah, absolutely, Peter. Sorry, I was writing a little note down there. So let's say you bought, and I'll use Whirlpool Corporation, big company here. And let's say Whirlpool stock, has fallen by 20%. So you had $100,000 in there. Now you got 80,000. Okay. And so you've got a $20,000 loss. Okay. Let's assume that that is a real loss from when you bought it to what you own now. You can sell that Whirlpool stock, lock in the $20,000 capital loss. If you have a gain, you could sell a company that you had a $20,000 capital gains, and those two would cancel one another out. So, yep, you locked in a gain, you offset it with a loss, and then you wait 31 days and you buy the Whirlpool stock back again. Okay. So they call that, to avoid what we call a wash sale. So there's some rules you have to follow here. But again, that's a very important strategy. Those are opportunities because it can help you not pay capital gains taxes down the road. So we have done in our office, obviously, capital loss tax harvesting here, and then a lot of Roth IRA conversions as well this year. So a very big, important time frame between now and, I'm going to call it mid-December, because all of a sudden you get into mid-December, you really need to have these things done by that time, so you don't have a rush at the end. And, we just say, look, let's call December 15th the end of the year. And that's how we work our calendar and our book of business.
Yeah, we get into the holidays and things tend to slow down or grind to a halt. So again, ladies and gentlemen, reason to be proactive and jump on your assessment of whether or not these type of strategies would be advantageous for you now. And Chris Mcintire can help you review and evaluate your complete situation, your portfolio, your investments, your retirement accounts, to help you to identify those strategies that would be beneficial for you and to allow you the opportunity to gauge and judge which ones and how to get the ball rolling on execution before the end of the year. But it is getting to the time where we need to act on these things in order to take advantage of the opportunities that we have. Give Chris Mcintire a call if you would like to have a conversation, if you would like to sit down for that complimentary review and evaluation. He can help you quantify the amount of risk in your portfolio, the fees and expenses, the taxes that you are likely liable for in the future, can help you optimize Social Security if you are facing that decision decision in the next few years, all of the things that go into your game plan for retirement, a plan that you will get in writing after that complimentary review and evaluation, a great benefit and extension and value add from this program. Give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, nobody likes to see the volatility that we've had in the markets, the losses that we've had in the markets, but along with that tax loss harvesting, also the Roth conversions that we've been talking about here, there are opportunities to be seized during periods of volatility. Even when we've seen financial and investment losses, there are things that we can do to be proactive. And sometimes those moves are the things that really improve our outlook and ultimately our results, is knowing when to make the right moves at the right time. Unfortunately, the emotion often gets the better of investors, and we end up missing those opportunities or doing the exact wrong thing at the wrong time.
Yeah, that's a good point, Peter. And one of those would be rebalancing your portfolio, making sure your stock bond ratio is where it fits your overall risk tolerance. And this has been a unique year because bonds have been depressed so much in prices. But there's obviously opportunities in the bond market to continue putting your money into stocks and bonds as you normally have been doing. Or if you've got extra dollars sitting on the sidelines, hey, is it time to enter some of those dollars into the marketplace? With the market down 25, 30% in some cases, is that a good buying opportunity to bring more dollars into it? And no question about it, that certainly could be a good thing. We don't know what the future is going to hold, obviously, and there are risks associated anytime you put money in the stock and bond market. And those aren't typically dollars that we are doing for the short term. We're not day traders. We don't advocate day trading. We're long-term wealth management, a wealth management firm with a fiduciary responsibility. So day trading is not something that we do. We don't advocate getting into a stock for a week or two and then selling it and getting out. That's just, too many things can happen that fast. Long-term, high-quality, dividend-paying stocks have been a very, fruitful, beneficial part of a retirement plan because you got dividend income that can come in as well, assuming that works within folks, their overall risk tolerance. Different types of bond or fixed income classes. There's some real estate holdings that you can look at, precious metals, an incredibly well-diversified portfolio. As disappointing as the results are this year, next year, doesn't indicate that we're going to have the same exact marketplace and even get worse. I think the outlier is probably the China-Taiwan situation, Peter. And if we look at that from a geopolitical sense, what the president of China has done here with some of his maneuvers is, looks like building more of a, I don't want to say a war cabinet for lack of a better term, but got rid of a lot of the reformers that had been in there for economic reformers and to build a middle class. They certainly seem to have gone the other direction. So that's probably an outlier on the international emerging market scenario for, throwing my 2 cents in there.
Yeah. Offensive posturing, we'll call it over there, certainly putting themselves in kind of a delicate, sticky situation and puffing up their chest a little bit on that side of things. But Chris, again, risks we've talked about often on this program are things outside of our control that can impact and determine our outcome. And there are things that we can do to insulate or isolate ourselves from various risks. We can control how much we are exposed to the market, not the direction of the market day to day. We don't want to try to time the market, but we want our portfolio, our dollars to align with our risk tolerance. We can't control what the tax rates are, but we can control when and how we choose to pay certain taxes and minimize our overall and lifetime tax liability. When we are fully aware of the costs of our investments and the guidance and advice we are receiving, we can control fees and expenses. those make a difference. We can control risk and safety. We can control when and how we choose to claim and collect Social Security. So there are things that we can do. And ladies and gentlemen, financial empowerment and your ultimate success often depends on recognizing those opportunities. So pick up the phone, give Chris Mcintire a call for that complimentary review, that retirement planning strategy session to custom design your unique individual game plan for retirement. 800-868-1194, the number to call. That's 800-868-1194. Chris, another big one here. If we have not already done so, it is the time of year for anyone born in or before 1950. If you are 72 years of age or above, and you have any tax deferred accounts, maybe less of a strategy, much more of a requirement, but we need to take those RMDs before the end of the year. The government is not very forgiving. The IRS didn't hire those 80,000 new agents for nothing. Talk to us about RMDs and what we need to know and understand.
Yes, it's that required minimum distribution season. As the leaves change, that's what happens in our office. And so again, if you're 72 or older, you have that required minimum distribution. If this is your first year to do that, it's about 3.65% of your IRA total. So if you have 4 different IRAs out there, you can add them all together and calculate what their distribution would be and take it all out of one if you wanted to, or 2 or 3 or all 4. If you have an IRA and a 401k, those are 2 different types of retirement plans, 2 different distributions. So some areas of confusion there. It's a lot easier if we're dealing with everybody that has IRAs, if you will, because we can aggregate that total together. And an example of that would be, we use a lot of safe strategies at Mcintire Retirement Services. So we might be taking the required minimum distributions out of the safe strategy this year versus an investment portfolio that has suffered a 10, 15% loss, for example.
And excellent point, because Chris, I was going to mention a caveat and a must know. It's not the current balance that those RMDs are calculated based off of. It is the year-end balance from the prior year. So some investment accounts may be down substantially since the market's down 25, 30%, depending on what index you're looking at. And many accounts reflect that as well. That RMD would be that percentage, that distribution from a potentially much higher balance than it currently is. So some of those safe money strategies and safe options may be a much more attractive way to handle and address those RMDs.
Yeah, absolutely. Because, on December 31st of 2021 is what determined the distribution for 2022. It's forward looking. It's not at the time you take the distribution. That's already been predetermined. And, so the market's probably down the S&P 500 in the range of 20%, for example. So why would you want to take another 3.65% out of something that's already down 20? When potentially you could take it out of something that, all right, maybe it didn't make anything, but it didn't lose anything. That would certainly make a lot more sense. And we do a lot of that. Okay. The other part, Peter, is, if people have a required minimum distribution, and this is for people that are over the age of 70 and a half, okay, you can actually take up to $100,000 out of an IRA and pay it directly to a charity. That is called a qualified charitable distribution. Where we see it with our clients is, let's say Mrs. Jones has to take out $10,000 from her IRA for her required minimum distribution for 2022. She could take all of that $10,000 and pay it directly to a charity. She doesn't get the check at all. It satisfies her required minimum distribution, and it's not taxable to her. And the qualified charity, a true nonprofit, gets it tax-free as well. So you kill a couple of birds. You can be charitable and also very good tax planning. And it doesn't have to be your whole required minimum distribution. Maybe Mrs. Jones wants to give $2,000 to the church and is going to take $8,000 to herself. Yeah, that's certainly something that's very common in our practice.
Well, you had earlier mentioned charitable gifting as one of your proactive strategies, and that is it, ladies and gentlemen. Those QCDs, qualified charitable distributions, a big one if you meet the right criteria and are in the right situation. One of the very few opportunities for truly tax-free money over the course of our lifetime. So if you do meet that description, over 70 and a half, charitably inclined, and have those RMD requirements, think through how you are structuring that. And you may have a fantastic opportunity for accomplishing all of those goals and requirements in kind of one financial maneuver and achieving truly tax-free money. Chris, all of these strategies need to be part of our income plan, thinking proactively on how to manage and cover taxes and risk and expenses. And there is still time, although it could be running short, to see how and where these strategies apply to our situation. So again, ladies and gentlemen, time also running short here on the program. Want to give you a reminder, Chris Mcintire gives you the opportunity for a complimentary individual review and retirement planning strategy session to put together your game plan for retirement. If you'd like to look at risks, issues, opportunities, strategies that can be advantageous, pick up the phone now and give Chris Mcintire a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, always a pleasure. Thank you for the time, the knowledge that you share with us here on Your Game Plan for Retirement.
Hey, my pleasure. I hope you got a lot out of today's show. Don't forget, do your year-end planning, folks. Good opportunities out there. My pleasure, Peter. Be safe, everybody.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.